market leader of Movement Mortgage, Sharon. So she basically covers the whole southeast of Florida. So she's a wealth of knowledge too between us two. So kind of just wanted to introduce ourselves and then kind of go into a couple programs that are kind of hot off the press or that we're seeing a lot of people take advantage of to help you, help us, help everyone kind of get in a home with these, rates kind of being a little bit higher. So, again, the main thing that we want is educating your buyer as far as, what the market's doing, as far as, prices, and that's your job. Ours is basically educating them on different products, pros, cons, what they can do, what they can't do, what analysts are saying, everything like that. So the first one, or the main point that Mike and Janelle and a couple other people want to be bringing is this new 2-1 Buydown program. So I know we passed out a flyer, and it kind of gives you an analysis of what it does. And it's not, I don't want to say it's not rocket science, but it's not rocket science. It just kind of explains what can help your client. So for somebody who is, maybe saying, hey, I want to put off buying a house because of the rates, or I'm scared of the payment. This kind of alleviates the initial shock when they were shopping 6 months ago. The rates were 3%. Now they're 7%. So, because I know that's, a lot of you guys are getting calls to get pushback from that. So this program, as you can see, and it just went into just a straight conventional loan. So we can do this on any type of product, as you know. And I mean, if some of you may not know all the products, but there's FHA, conventional, VA. Okay, so this product specifically, what it will allow you to do is buy down the rate. So it's basically a 2-1 buy down, meaning in this example, the rate starts at 7.5, 2% down is 5.5, and then the 1% is 6.5. So as you can see on this, the difference in monthly payment, so again, this is on a $647,000 loan, $200,000 loan. So that's what the mortgage would basically be based off. For the first 12 months, 1 through 12, you guys can see the rate since it's a 2-1 buy down. And again, the rates are a little bit lower, but this is just kind of analysis what it is. It would start at 5.5%, which again, to me, what I'm going to tell a client is your monthly payment on that would be the $3,600. Okay, so that would be for the first year. After that second year, basically, for again the 12 months, it goes out to about $4,090. And for the rest of the remaining term, it goes down to up to the $4,525. So what we're telling a client, as you can see, is that difference of 2% of rate is about $1,000 a month on this scenario, on a $600,000. If it was a $200,000 loan amount, it's going to be a lot different. But on this, basically $1,000, which that's a big chunk. Now, one of the cool things, or what the main reason that they're reeling this out is a lot of you guys have heard of buy down with points, right? Okay, so this, you got to scratch out. This has nothing to do with that. What points are, and I'm going to touch on that and come back to that. So points are basically, like for instance, if someone came to me today and the rate's at 7.5%, before this product, I could say, listen, if you want to pay a point, you can get your rate down a little bit. So when people say points, 1% is 1% of the loan amount. 1 point is 1%. So it costs $6,000 upfront for the client, and he would go from 7.5 to 7.25. If you wanted to pay 2 points, simple math, 12,000, and would go to 7%. So only dropping 0.5% is going to cost that client like $12,000. And in payment, I think I did some math right here. So the difference between 7.5 and 7% by buying 2 points is only $200 a month savings for $12,000. Then what you do is say $200 a month times 12. You see the recoup. By buying those points, it's going to take 5.3 years to recoup your costs. So let's say in 2 years that this guy refinances, because rates are lower, or they get divorced, or they die, or they sell their house. That money that they paid, they lose. It's done. So that $12,000 in points is gone. So that's kind of when back in the day when someone's like, Rick, hey, I want to buy my rate down. I do the simple math. Hey, it's going to cost you $12,000 to do this. You're going to save $200 a month. It's going to take you 59 months to recoup. How long are you going to be in the house? oh, Rick, well, no, we always sell our house, or hey, we may refinance, or, you know, most of them don't say they're going to get divorced, but that's, I totally doubt, you know what I mean?
4%.
But
You
that
start
just,
your home,
yeah,
move
so,
up.
yeah, correct. So it could be something, you know, hey, by that time, the kids are going to be out of the house, we're going to downgrade, or we'll have more kids, so we're going to need to upgrade. So that's the definition of points. Discount points is what they call. So as you can say, it is a savings, but it's not as good as this proposed new hot off the press item. So the cool thing, and I'm doing the analogy, like I said, this one right here, the total buy down funds on this, it's usually 2.5% of the loan amount. So let's say on this one for $640,000. Yeah, and you guys can write that. So the cost usually to pay for this buy down is 2.5%. So what that means is, you can see, let's say the client, same thing in points. Let's say the client says, Rick, hey, instead of buying down points, I want to give you the $15,000. I'm like, cool. Your payment, remember I told you these points were only going to be $210 and the rate's only going to drop 0.5%. Drop this guy 2% and the payment's $1,000 a month savings for the first 12 months. And then again, it goes $500 and so on and so on. And as you can see, the one, again, another cool thing about this is that $15,000 goes into an escrow account. So like a separate escrow account, not like for your property taxes insurance, separate escrow account. And then whereas points, you pay those up front and they're done. So let's say this guy puts, you know, $15,000 in escrow account. What Movement does is we take, you know, the amount, the difference, and it will show you the monthly amount be paid from the buy down funds. We take that money and put it in that account to supplement that $4,500 payment, because now it's only $3,600. The cool thing on this is, let's say year, you know, the first year, year two, that the guy, they divorce, they sell the house, the rates come down low, that money, they don't lose it. It goes right. So let's say we get a payoff, they sell the house, we're closing. Whatever money's in there. So let's say, for instance, that the first year, as you can see, the total buy downs is about 10 grand. So the first year, you know, they say, you know what, we don't like the house, or hey, we're downsizing, whatever. That extra 5 grand, when we get the payoff on the loan, or when the title company does, it goes right on their balance. So they don't lose $1 of it. So you don't have to worry about recoup time on this, which is pretty cool. You know what I mean? So it's right there. So the whole idea of this program is that rates have gone up, right? We all know that they've doubled, maybe even tripled. That most analysts are saying they're going to come back down. Now, whether some have said, I mean, Sharon and I are on all kinds of subscriptions to networks and this. Yeah, some are saying by the end of the year it's going to go down. Some are saying mid next year. Elections is set. You have all kinds of stuff out there, and we don't have any crystal balls, neither do you. But this is almost getting a person the same rate you can today, but giving them a little bit of incentive that, hey, if they do happen to come down, that they can refinance and they're not losing any of that interest or any of those buy down money. Plus, they're getting in at a low monthly payment rate. Now, we qualify them at the higher rate. So we're going to qualify them at that $4,500 payment. But they know in the back of their head, for the first 12 months, I only have to stroke a check for $3,600, which is pretty cool based on their budget.
Right.
So that's
Couple that with a buy down.
Yeah, correct. 100%. So that's the main thing, that this program is just kind of giving some relief on rates to clients, to us, to you guys, to kind of just rebuting their questions. Because like I said, I can't tell you how many people I've pre-approved 5-6 months ago, and they're saying, well, I'm just going to keep renting, or I'm going to wait for the rates to get down. That's when I educate them. I'll show them that spreadsheet. You know, from when I came in, when 23 years ago, when rates were at 12%, Sharon's been doing a little bit longer than me, but her rates probably are a little bit higher. But so I show them that comparison. So when everyone tells me rates high, I kind of laugh at them. I'm like, what's your definition of high?
Yeah.
And just when they say to you guys, oh, these prices are crazy, you know, you show them trends, you show them whatnot. I mean, real estate, Mike and I talk a lot. I mean, I own rental properties. I've, you know, bought my first duplex when I was 16. Mike buys property. I've never got burned in real estate. Now my E-Trade account, my 401, you know what I mean? So, and rates do this. Now the thing, what I'm telling a lot of these people, I'm like, okay, you're going to wait, but guess what? What they're all calling me and saying, my rent was $1,200. Guess what? Now it's $1,600.
I just read this thing about somebody waiting, just to tag on what you were saying there, somebody waiting, they're waiting and you don't know where the interest rates are going, they could go up, they could go down, but meanwhile, property values will always continue to go up. They're not gonna go up maybe like they have been the last couple of years, but even the national average of 4 to 5%, they're still predicting. So why would you rent? Why would you wait because rates are up when property values are always gonna go? So it's always a better investment to buy than to rent. And they educate them on that and tell them, what's the latest saying? Marry the house and date the rate.
Yeah,
So buy that house, get into the house now. In a year or two, you can refinance and get a lower rate. So if you have people that are sitting on the fence, if you have people that are sitting on the fence 6 months ago, call them back and say, look, it's going to increase. Values are going to increase. It's always a better investment for you to buy than to rent.
Because you always have to pay. My old man told me years ago, you always have to pay to live somewhere. So whether you're renting or you're buying a house, your mortgage. And I can't tell you how many, the first time home buyers, it is a little bit tough right now. But when I do the payments on some of them, the rent they're paying is unbelievable. And you guys know that. So when I sometimes can get them in the office and show them the difference of the payments, or you guys get them in my office and I show them the difference, they're like, really? And then as Sharon was saying, usually property value, we may not see the crazy adjustment, but property's always going to be worth something. And they're paying down their principal and all this stuff. This is just another tool so we can get somebody maybe, that they were like, damn, Rick, you told me my payment was going to be $1,500, when the rate was at 4%. Now you're telling me it's going to be $2,500. I can say, hey, well, this is what they're predicting. Maybe we can get you in a split the difference. And then they're like, oh, okay.
Especially if you have somebody that's like, say, that's started a new job and they're going to be making more money down the road. This helps them get in now with this payment and know that their payment is going to increase, but maybe they're in sales and they know they're going to increase down the road, or they're just getting out of college and they're just starting a first-time job. This will help them get in at a little lower payment now, knowing that it's going to go up. Yeah. The other thing that I love the best about this program for you guys as realtors is selling this to your listings and to your sellers, that instead of right now when properties are staying on the market a little bit longer, instead of doing a price reduction, which will hurt your comps in the future, say, hey, Mr. Seller, instead of doing a price reduction, let's offer a $10,000 buy down, right, which will still help your prices, but give an incentive to the buyer to get in with a lower payment. So I think for you guys,
I think we need to touch more base on that, because that's the reason that most of these people are here. How do we connect the dots and get this into the right hands and get you the right people? So you just said it there. So who can pay the buy down?
So the cool thing on this program, now, a lot of you guys and a lot of my colleagues and we all chat whatnot. Movement Mortgage is allowing the seller to pay for the buy down. So you're going to see this advertised a lot of places, but usually it's only the buyer or the builder. So Movement Mortgage, I think there's another company, I don't know, but I heard there was. I mean, I'm not scared to tell you the name if I do, but a lot of the people that probably are in this local area, if their company's doing it, the seller's not allowed to pay. So the buyer would have to come up in this case with the $15,000.
So for you guys,
the cool thing, like
so
Sharon was saying and
yeah.
Mike was saying, and I'll let Mike touch on that because he's the expert for how to, do that to the listing agent or whatever, is you guys can go, because let's say in this case, a $700,000 house, and, you guys are saying, or somebody comes in at 690 or whatever, you can say, let's not do that. Let's do it at 700 to keep your values up for comps and everything, but give me a 10,000 seller credit. And the reason why is because of X. And I mean, if you see that in black and white, it's almost a no-brainer because you're not losing $1 up front of that buy down. That's just the cool thing. Yeah. So as far as writing it in the contract, it's the same thing. It's basically a closing cost. So it's, seller going to pay for closing costs and prepaid, just like you guys do on everything other else back in the day when it was creative. And then the way to pitch that to, a listing or whatever. I mean, I'll give you, what do you think?
It's just a seller credit, right?
Yeah.
So,
it's a seller credit.
Closing costs and prepaids. And I know that not everybody was in that market, by the way. So we have to clarify.
Okay.
So, the last 2 years, we haven't been able to get a seller credit.
Correct.
Right.
But now we're doing it the reverse way. Now we're going to have the listing. We're going to get the seller to agree to the credit. We're going to put it in the MLS that way.
And explain.
And when it comes in, and explain what it is. And if you can't explain it in detail, you just get them with them.
100%.
That's it. Okay. And it's a benefit for the buyer of the house. And now it's a new marketing tool for you, right? You can put in there that, hey, this includes a 2-1 buy down, call me for details, and then just refer them right down.
That's the
And
way
then-
that I would market it. This
Yeah.
is, we're gonna
Get
give
the
a
calls.
$10,000 credit.
And in
for-
the back of your head, if it's a $200,000, 300, you just know that it's 2.5% in the back of your head. So if you have somebody, if you go to pitch this or something, I mean, definitely you can get with me, but if it's $200,000 loan amount, hey, we're going to come off a $5,000 seller credit, basically is all you have to say. And then, I can do the analysis with the payment breakdown to share with you, to share with the seller, or if you have a potential buyer. You know what I mean? And
I think you'll get leads like crazy if you start
100%.
advertising it that way. You're gonna get the buyers that are motivated, they're looking to buy, but they can't get over the interest rate piece of it. This is it.
And the cool thing, what I'm at the edge, like I said, when I told you guys, and we can go into more detail on the points, whatever, everyone thinks that this program's the points, like the example I gave you guys, but it's not. It's because buy down, that's what some people used to call points, buying down your rate by paying points. This is a whole different ballgame. So it's a little bit different. So even if you're talking to your seller, they're going to say, buy down, oh, why am I paying points or anything like that? Or the buyer or seller may say that, why am I going to pay points for the guy? But this is totally different. So that's where you lean on me, the source.
Hey, we want to be the resource of the story.
Yeah,
Yeah.
and I can explain that
Yeah.
to you and, go from there.
Okay.
So,
One thing I'm just thinking of, because I know you're about to move on
Yeah.
to the new product, before you do that, they're qualified at the higher payment, right?
100%.
So what would happen if they took the difference in payment that they're not paying and paid it down towards the principal? Can you recast?
You can recast, you can re-amortize, you can do anything.
Now you're
Now-
talking about a 30-year mortgage going to like a 16, 18 or something like that.
Yeah, it may not go that much, but depending on how much extra you pay on principal, you're gonna definitely see that down. And not only that, like Mike says, let's say this program, let's say the analysts are right in 3 years and they're paying $4,500. Let's say they're spending $5,000 and in 2 years they refinance, then they're simple math. Your balance goes down, and then if the rate goes down, they're gonna maybe save $1,000 from what they were paying from that $4,500 payment. But the cool thing is they're not losing any of the interest that they're paying up front. So this $15,000 is basically interest up front. They don't lose $1 of it.
And if they win the Powerball, they can
They can pay it all.
They can pay it off.
Same type of scenario. So like I
Okay,
said,
all right,
conventional
that's-
VA, FHA, no prepayment penalty, nothing,
That's-
like no
that's a-
caveats of these
that's a
guidelines.
big
It's the
thing.
same type of loan. It's just a buy down that they're getting off.
So no prepayment.
No,
penalties.
nothing like
Okay.
that. Nothing. There's no like red tape or anything crazy on this type of loan. So that's what's kind of cool.
That's.
Yeah.
So where I think like I said before, the biggest benefit to you all for listings is to pitch this to your seller but it's also a first time home buyer that's only putting 5% down, and they'll have an extra $10,000, but they're nervous about the payment. Say, hey, first time home buyers have extra $10,000 or $15,000, but if they do, they could put that to help them ease into this higher payment.
Yeah, or the people calling me with big dollars putting 50% down. They love it because what's another 15,000? Their 15,000 that they got in the pockets doing nothing in their E-Trade, doing nothing in the bank. It's under 0.01. So I'm saying you're prepaying your interest right here at this rate. So it's a no-brainer if they know what they're talking
So
about.
that's the
my
key to
job
remember,
to-
that they're prepaying the interest. That's all they're doing, is prepaying it up front, so their monthly payment is less.
right.
Yeah.
And to go back real quick, so as you guys may know, on the seller credits that you guys sometimes put on your contract, whether you're new or been doing this for years, again, there's 3 types of loans. And I can email, or Mike will put this out, or if you want to write down. So FHA, the lender allows 6% of the price as a seller credit. So 6% of the price, which is a lot of money. So they're more the generous one. So FHA, 6% of the sales price. VA, so for the veterans, 4%. Okay. And I'm just going to throw this out. I do a lot of VA loans. We have a lot of veterans in Florida, aka even Indian River County. And I love working for veterans. Movement Mortgage is huge, helping veterans. We usually charge, like we have most lenders have a processing underwriting fee of like $1,000, $1,500. We do too. Conventional FHA. VA, our way of giving back is we waive that. So 0.0. We don't charge $1 for veterans. So that's something that's pretty cool. And I can go in and say, hey, our way of giving back is we don't charge you $1. And it's no BS. They're not putting it back in the loan, or we're not jacking the rate up. It's literally something that our CEO is very adamant about. So that's a cool thing. So again, VA is 4% of the sales price you're allowed on a seller concession. And then conventional gets a little tricky. So conventional, if the client's putting less than 3% down, or less than 10% down, I'm sorry. So conventional, less than 10% down, you can ask for 3%. Okay. If they're putting 10 to 25% down, they can put 6% seller credit. So 10 to 25% down, you can ask for 6%. 25% or more. So if we got a big baller putting a whole bunch down, 9% of the sales price is allowable on conventional. 9%. So ultimately, if you have somebody that says, "Hey, I'm buying a house for $600,000. I want to put $300,000 down, but I don't want to pay $1 plus I want the buy down." And this costs 9%. You do simple math. It could count for that plus all their closing costs. So literally, they could come to closing with just $300,000 because some of them are like anal like that. They just like that. That's all I want to bring. We can work that because 9%. That's a lot of money. That's more than what we need. I probably only have ever had to do like one or two where they've gotten close to that.
Yeah.
So now remember, going back to how much the buy down funds cost. What was that? What did I say? Do you guys remember? 2.5%. So as you can see, pretty much, or definitely on all of them, it's going to cover it. And if there's any, like, let's say if you guys get me 3% on conventional or something, I'll put that other 0.5% towards their closing costs or title work, doc stamps, anything. You know what I mean? So that kind of is another incentive. So the buyer's happy because not only they getting a better rate and, paying for the buy down, but they're getting a couple bucks paid for all the other, admin fees, title, process and appraisal, whatever you want to call it.
The only other caveat on that is investment properties. On investment properties, they can only get
Correct.
2% seller credit.
Yep.
So if they're buying it as an investment property, it's only a 2% seller credit.
On conventional.
On conventional.
That's what it is.
Well, you can't do FHA.
Yeah, so all of you guys know FHA, VA has to be a primary conventional. You can buy primary, second home or investment. So, we do offer this to some investors because, again, it could be cool for some investment. If I was going to rent a property and I knew my rent was going to be $3,600, let's say on this type of, I hope I'm getting $5,000 a month or something in rent. I could take that $1,400 as investor, maybe go use that to buy another property or do something else with. So it can kind of work for anyone on that.
Yeah, definitely.
Do you guys need any clarification?
Yeah, I know I kind of sometimes talk fast.
Yeah, me too.
Whatever,
Any
but
questions?
Couple-
Are you doing anything for FHA? Because used to have an escalating 2-1 buy down for FHA.
kind of, well, that basically back in the day, so there's a couple things. FHA had that buy down, but it was more, it was like the point buy down. So it wasn't as big of a spread. Like this is 2% on the rate. Then the FHA did come out, so did conventional had the regular buy downs, but it wasn't as unique. But old school, they used to do it, but this is totally different. But this program, you can do FHA. It's the same scenario, kind of similar to whichever one
Well, since
you remember.
since the 10-year, 2-year, 5-year are inverted, I'm assuming you don't have any aggressive 5-1, 7-1, 10-1 on products.
Yeah, we do. Well, yes and no. So good thing. So the arms really.
Who knows what an arm is?
Okay, so mortgage. What arms are? Say they're not like these or anything. Arms and mortgages, they're adjustable rate mortgages. So back in the day, or a lot of people, like when rates were 10%, you could get an adjustable rate. Let's say it's 6%. So that client was all happy because they're getting 4% lower than market. Pros and cons to arms. Like the gentleman said, if it was a 3-year arm, 5-year arm, 7-year arm, 10-year arm, it was only locked in at that lower rate, initial rate for the 3 years. After that 3 year, depending on what market is, it could go up or down. 5-year, same thing. So the thing is because interest rates are still relatively low and they've went up so fast, investors really haven't got really into the arm market. Now, that being said, could I give you an arm and maybe get 0.5%, but the risk doesn't outweigh the benefit usually, and I'll tell a person straight out. Now, one good thing too that we have is we have a jumbo. So if you guys get, a jumbo, which a jumbo loan is anything over this 647.2. So if you guys get a sweet listing on the island for $1 million and somebody wants to finance with us more than that, we do have a pretty cool jumbo rate, which I checked it. What was the analogy the other day?
It was at, let's say the 30-year fixed rate was at 6.99, but the 7-year arm on the jumbo was like at 5.375. So with no points and no cost. So the jumbo arms are pretty sweet right now, but the conforming arms, like you said, you must know the market pretty well with knowing that the rates are inverted, that the conforming arms right now aren't desirable.
So the market on those arms. So if I was talking to, someone doing a jumbo loan, meaning again, 640. And I said, hey, you can do a 30-year fixed at 7%, meaning that rate is locked in for the 30 years. Or you can do like Sharon said, a 7-year arm at 5.6. That spread may be enough for him to say, listen, I'm either going to pay this loan off, or I'll use it. I'm going to get divorced, or I'm going to downsize or something. But he knows for those 7 years that he has that lower rate. So, and again, Mike and I talk about the market, and back in the day, adjustable rate mortgage, they're not bad. They can be good, but it's for the right person. And I assure you, if I talk to any of your clients, because I've seen it, I mean, we used to do these. No, I was in the market when the arms were, they had these negative arms, and they don't even do them anymore, but you were at a lower rate, but you weren't even paying the interest payments. So let's say you start at 200,000 from 2 years from then, and then guess what your balance was? 220. And then guess what your house was worth? 160, and then you put the keys in the mailbox. So they're not doing those no more. But the arm, if someone came to me and said, Rick, hey, I know I'm downsizing, or I'm moving, or I'm going to, do something, then I would say, okay, as long as you know the pros and cons, it could be a good product.
For us, it's all about what their needs are. Okay, like he said, is this going to be your forever home? Then take a 30-year fixed. If you think you're going to stay in the house, the average used to be 3 to 5 years. I think it's 5 to 7 now. If you're going to stay in there 5 to 7 years and the arm is better, take the arm. And that can always change, but
it's just educating them, and that's kind of our job. And then you should know a little bit about it too. If the client says, hey, what the rate, something like that. I mean, I know you don't want to get into too much of this stuff, but this is good for, for buyers. And I think that is actually sweet for if you go into a listing and kind of pitch that as one of your marketing items, say, hey, we have a lender and this will attract more buyers, because we're seeing a lot of, again, and this is brand new to me, to a lot of companies, but I'm getting a lot of phone calls about it and a lot of interest. Because, I mean, I wouldn't sit up here and pitch a product that I didn't think that I wouldn't do.
I think I would be concerned if you weren't qualifying based on the higher rate. But the fact that you are means that you're not doing it the way they did in 08 when it crashed.
And what Mike means like that, like back in the day, like let's say, the arms, you were qualified at that low payment, so they shouldn't have even been there, because when the payment got up, they couldn't afford it. And there's so many regulations between us and even you guys now that those loans are long gone, and it's not going to happen.
And even on the arms now, they used to qualify in the initial rate, but now you have to qualify on the they call it fully indexed rate, or the current rate, just to make sure you don't want to do a disservice to the borrower. You want to make sure they qualify when the payment goes up.
So you have other programs to go over, right?
Well, yeah. So that's just something, and we could circle back around. Not too, there's a couple things as far as, so movement. I told you about the VA no lender fee. So if you guys, get a buyer and, hopefully you're asking, what they do. If they are veteran, you can even throw that out there. Hey, our in-house lender, actually has VA programs that don't even charge you any of the lender fees. Now they have to pay title and everything, but I can't tell you how many veterans that I've helped where they've come to the closing with zero. I mean, we don't charge them everything. Let's say the closing costs are $4 or $5 grand. You guys get them that on the seller credit back in the day or something like that, and they don't come with $1. I mean, Linda, I'm not going to pinpoint you out. I think we've worked with some veterans before, and it's cool seeing them getting a house for since they served our country, and seeing them getting able to own a home and basically sometimes not even bringing $1 to closing. I've had them get money back at closing.
I
Get
have
up to the
to.
bottom line, right?
So that's a cool feeling, and I get goosebumps about it, but that's a cool feeling on that.
The other thing I wanted to talk about was the Hometown Heroes too.
Yep.
So I don't know if you guys have seen much on the Hometown Heroes, but it's a Florida bond program. Bond programs in the past, I feel like have always been a little tough. It's a great program, but the new one, this Hometown Heroes, gives you 5% of the loan amount towards closing costs and down payment. And what's even better about it, the income limits go up to $130,000. So in the past, it was only like $50,000, $60,000. Now this is opening the door for a lot more people to qualify for this Hometown Heroes bond program through the state of Florida, first-time home buyers. But if you're a veteran or an active military, you don't have to be a first-time home buyer. So we're just starting to see a lot of traction on the Hometown Heroes. And it used to be just like, let's say, teachers, firefighters, nurses, but now they've really expanded the list. It's like pharmacists, dentists, hygienists. There's a huge list of that, which Rick has, and he'll send out to you guys.
I had the one list, and I don't think it was, and then Michelle, I sent you, I think individually, maybe a updated list, because I know, or I think I sent it to you.
They keep adding occupations to it, which is,
that the new list?
The new list, correct.
Yeah.
I printed it.
Okay.
It's on my copy.
Yeah,
Oh,
so I can
nice.
send, or I'll get it to Mike, because the last one, when we did something, it had, and like Sharon said, it was specific, it was small list,
Small
just like
list.
anything, and they have so much money allocated right now to give out, that they're making it big to use the money.
yeah, they've
You know, 'cause
expanded
it's
the
government
occupations,
funds.
so.
That's kind of a cool program for first time homeowners or for whoever, because it, you know, we can talk about that
Yeah.
more. I want to mainly specify on
The
the,
bond program, I mean, the 2-1 buy down.
yeah, the
program
buy
today.
down. Programs.
Rick, I just want to confirm that Movement Mortgage will pay the VA funding fee?
Not the VA funding fee,
Okay.
the lender fee.
The
So,
lender fee. Yeah.
so like I was saying, we charge like $1,000 for processing, underwriting
Oh,
credit. So
gotcha,
that's the fee.
Okay.
Yeah, no.
That's the fee that we waive.
Only way you can waive that is if you're more than 10% disabled. To be able to waive it.
Gotcha.
Good question. I wish I could pay.
Yeah, for sure.
Another cool thing, the movement, which I know some of you done, I mean, and right now, sometimes I'm getting some buyers that are a little bit more challenged just because of the rates are higher, so it's getting tougher. That, you know, even myself or Sharon are kind of like, wow, this is a real tight loan. We do upfront underwriting, which we done that forever, and we used to not have to take as much advantage of it, but I have. So if I have a buyer that's a little bit unique, meaning just moved up here from Miami or self-employed or anything like that, I can give him a pre-qualification. I can give you guys a pre-qualification. I said, hey, they look good. But Movement Mortgage go the extra step and get him basically approved so that there's no issues, that it's done. You guys get a contract and he's done. So if you guys gave me a buyer and, you know, I may say, hey, I'm 95% sure that it can get done. I like 100%. That's just like how I roll, because I don't want to let that buyer, you guys do your job, get him a house, everyone's happy, and then, you know, not right before closing, because we underwrite fast, but close say, hey, guess what? Now we can't do it. So if there was a challenge and you guys come, I would tell you, hey, I'm going to do upfront underwriting, get all the client stock, send it to an underwriter to get their hands on it, which if you guys don't know what an underwriter is, they're basically God in our world. We put the stamp on it. So underwriter can look at it and say, hey, Rick, this client's good to go. That's when I'm going to say, hey, you guys go find him a house. We'll close this quick. You know, so that's one of the cool things. So if there was a challenge buyer, you may see me push back on that and say, hey, I'm going to go the extra step. Give me a couple days. Usually only takes a day or two. And then I'm going to make sure it's 100% good. So that's a cool thing too. And then as far as like how quick we're closing loans, I mean, we're closing loans in 7-10 days if we want to. So I'm going to have a couple people, you know, back in a couple months ago with these appraisers and everything. I mean, it was taking them 10 days because their orders were so big. Title too. Now that it's slowed down, it's kind of getting back to
Normal
where we can
times.
rock and roll again. So if you have somebody in a bind or needing something quick, we can do it. Okay.
Can you talk about buyers wanting to shop rates a little bit?
So basically, you know, just like what I'll use an analogy, like somebody almost shopping you versus an agent. I don't really, and for some reason, I developed such a relationship with my clients, or I get a rapport, that I very rarely get question on rates because they trust me and I don't try to BS anyone. I shoot them straight. But if I have somebody that says, hey, Rick, I'm shopping you with X or Y, whatever, I'll look at everything. I'll look at the math. I'll get a real estimate to make sure it's not crap or they're just saying like an internet bank. Plus, I'm going to say, hey, you know, a lot of these banks, you don't know who they are. So many companies right now are going out of business. I can't tell you a couple of the calls I've gotten in the last 2 months, like, hey, my lender ghosted me. Or this company's out of business and just got sold. We're going to see a lot of that because when tough gets going, you know how that saying goes, whatever. But if a customer is like, if I'm truly getting beat and it's legit or whatnot, that's when I go to my boss and say, hey, I may need some help. And we dig deep and try to get it done. So I don't know if that's where you're going, but, you know, our rates
We're
are.
not a new agents here, and we're dealing with buyers that are shopping rates,
Uh-huh.
especially right now.
Yep.
So, it's not always true when it comes down to closing.
100%. Because a lot of I mean, what I say is basically,
Or something along those lines. I mean, along the lines, they're quoted an interest rate, and it never seems to be true.
From other companies or me?
Well,
Other companies.
internet.
Oh, I was like, come on, girl. So yeah, from 100%, and you know what, and 90% of the time, and I'm not gonna say any names, Quicken, they put points, which again, I'm going back to, you guys remember, not to buy down the points. I can't tell you how many times they said rent, and then I get there and there's like $20,000 in points. And I'm like, then I educate the buyer, which is nothing. It's like, look at the closing costs on mine, look at the closing, apples to apples, numbers don't lie. That's why I love this business, the numbers don't lie. You know what I mean, on payments. So that's what if I get beat up, which I really don't for some reason, luckily, I guess, then if somebody's shopping rates, I compare, I'll get an analysis. And if I do have to, there may be some room.
And you really have to educate them, like you said.
And then your job too, if somebody's,
The point is that they're gonna get educated instead of doing Rocket Mortgage, Quicken, and all those stupid ones online.
yeah,
Whatever they get quoted is strictly a piece of paper.
Correct.
It has zero meaning. When they go to movement, they are getting educated, they're getting pre-approved, which is more than pre-qualified, and they're gonna have a better outcome. So.
user experience, it's all local. And I know a lot of, some of you guys have used movement, and I don't think anyone's really had a bad experience that I know that, you know. I'll ask Linda, I'll put you on.
Never, 100%.
Yeah, I mean, and, you know,
Well, what-
Linda knows where I'm at, she knows where I may have a
Can you
cocktail
go over the
at, so if I
difference between
need
a
something.
pre-qualification and a underwritten approval?
So like I was telling you guys on the upfront underwriting, so this is kind of important. So if somebody gives you a pre-qual, like Kim was saying, sometimes those pre-quals are worth the paper it's written on. It's really nothing. I've seen a lot of them that they haven't even pulled credit, you know, and telling this person, hey, you know, Linda, go show this client a house, they're approved. And that's sometimes where if you've gotten burned by that, your rebuttal is, Linda's like, no, I know it's not. Go maybe get a second opinion, or did they do their due diligence on that?
No, I
So-
just haven't talked to you.
Well, 100%. But a lot of times they're like, no, you know, I got my stuff with Bank of America, or I got my stuff, which I love the loyalty on that. But sometimes where Mike was going to pre-qual, sometimes I'll pull credit, sometimes I'll pull income, but a lot of times they're just going off what you say. Hey, I'll make $100,000 a year. When I get the tax return, on shows I make $20,000, but they're saying they're going off what the customer says and just using those numbers to let you guys put them in your car and go find a house. A pre-approval, now I do pre-quals too, but usually pre-qual, I get a lot of the documents and I know too. Because I'm not, you know, I got to see you guys at Publix and all that stuff, and I got to see the clients. So I'm not going to tell you to go give this guy a house if I didn't even look at anything. Pre-approval is like what Mike said, I was setting up for an underwriting. If I think it's a little bit gray or could be some challenges, I'm going to put it in front of our underwriter and say, hey, I don't want a pre-qualification, I want a pre-approval. So it's done. All I need is a contract, title, and appraisal, and let's close this. So that's the cool thing about a pre-approval versus a pre-qual.
And I think it depends on the borrower too. Like if you have a salaried W-2 borrower that's been on their job for 20 years and they have 800 credit score, you know, that's an easy pre-qualification.
From anyone, correct.
Right? But if you have somebody that's maybe variable income, there's like
Realtor.
self-employed realtor.
Yeah.
Oh, realtors.
And that's the tough part. You got to know what you're doing. And I'm not saying I learn something new every day, but just being around this, I kind of know. And our team, assistants, processors, underwritings, market leaders, stuff like that. If I have any assistants, they have my back, which is pretty cool. Kind of like you guys.
So
pretty
your
cool.
underwriters you can call them immediately.
I text them.
You
Text them, call them. We have that rapport.
Yeah.
I mean, I did work for Chase for 16 years and I couldn't call. They wouldn't even allow me to do that. You know what I mean? So it's cool now that I'm with. Now, there's a bit difference between banks and mortgage company. And again, I'm not going to talk bad about any Bank of America, but, you know, it's different because they don't really have the rapport. You know, the local, they may be somewhere in Michigan and they don't, you know, so you don't know. The loan officer you guys may be talking to may be in New York or something. So, you know, I like the local feeling, and I'm sure whether it's me or we have a lot of good local mortgage companies around here, and a lot of the girls and guys, we run stuff off. It's kind of cool. We have a good relationship. We don't hate each other or anything. So that's one thing cool. Now, when we see an out-of-state lender or something, or an internet lender, sometimes that's like, man, keep it local, keep it in a community. You know what I mean? Just like you guys do with inspectors, just like you do with, someone's gonna hire an agent in Miami to come represent their house up here, keep it local.
Right.
Let me just say something to that point, because I had a seller of a listing, and the buyer's agent presented an offer. And I was like, oh, I don't know that I've ever heard of this thing. Oh, no, it was Bank of America. Yes, it was. And we get almost to closing, like days before closing, and find out that they're not gonna get approved for something additionally that they wanted from the association, which the other banks around here weren't wanting. And I was like, see, this is why I wanted to go with a local lender, because they know what's going on in this area. They've worked with all of these homeowners associations and condo associations and everything for years. These other people don't know us from anybody. So using local is definitely.
Yeah, local with everything. Like I said, if that was me, and I'm sure that loan officer from Bank of America wasn't going to pick up Michelle's phone or maybe dodging her, guess what? I bet Michelle can find me. You know what I mean? I can't hide from her. I'm going to have to answer that call. Yeah. So I mean, that's the one thing, and I assure you, I love my job. I love my company. I mean, I take this passion because it's it's your client, but it's my client too, and it's their probably biggest financial decision they're going to make in their life.
Yeah.
You gotta know. So I don't that's why I'm saying I don't want to give like a pre-qual or anything like that. I want to educate them and don't put them in a shitty product. I want to make sure that they know everything, comfortable. So when I do see them at Publix, Hiram's, Earl's, something like that, they're not trying to fight me. They're trying to buy me a beer or say, hey, you know what I mean? So that's kind of, and I'm not patting myself on the back. I'm just saying reality, because I've seen it the opposite way. And I've seen you guys, and I'm sure you've had experience where you got ghosted, and I don't want to talk bad about other lenders. That's not what I'm about. But I've seen other lenders not treat your client or yourself or whatever. And it's not just a good experience, because it's already tough. The whole getting the house, the inspections of that. And, it's just, if everything runs smooth and everyone works together, it just makes such a good process, which creates relationship, which creates referrals to this, to that, and makes it all a good process.
So I would say that's where communication comes in, right?
Yep.
So the lender that you use, you should be able to talk to without having any barriers. And I mean, like, if you know that they're shopping, tell him that before they do it. Okay, because he's going to be able to explain what to look for, and that way they won't use the other one. That makes sense, because they'll be able to know to look at the closing costs differential and see that they have a $20,000 nut that they have to bring up, and they'll be able to say no. What's been happening is they don't know the difference. They were never told the difference, and we just let them go, and they shopped it based on a rate that's not even a true rate. So they flop. Now you get 3 days before closing, and now it doesn't close, and we have to do a 911 back. 911 means that this deal was either it's closing or it's dying. It's one or the other. And sometimes they can save it, sometimes they can't.
Yeah.
Right.
It just creates a bad taste in everyone's mouth, So that's ultimately what it was. And I mean, we have, a lot of products and everything like this. This was just something cool that came out as far as going back to this Buydown that I think in this market now, because I don't know what the rates are going to do. I've never seen in my history, I don't think really anyone in this history in this room go up this fast and whatever. So, I mean, could it come back down? Yeah. Could it keep going up? Yeah, I don't know. So it's kind of a unique market in my world and in your guys too. So just got to play the game, be smart, a little bit creative and educated. That's what I'm here for. So
Let me just say one more thing. I just want to touch on the 911 thing. We have a 911 program that if you have a deal that's gone south, we call it a rescue loan. And if for whatever reason we can do it, like Rick was trying to save one the other day, the condo got denied at the last minute because of litigation, or somebody gets denied at the last minute. It's like all hands on deck, and we try to rescue that loan and save it. So it's a special thing at Movement, a rescue loan. So just keep that in the back of your mind. Not that we want you to have it go to somewhere else.
yeah, I hope you
All
guys.
right. So you talked about the 2-1 buy down, which is a great program. Sounds like a very easy thing for us to. How many of you have listings right now that are overpriced? I know you do. Come on.
Trick question.
This would be a great way to try to put more money in your seller's pocket while helping the buyer and helping facilitate the sale. It's just another tool, okay? It's not that they're gonna do it, it's just something else to bring up to add more value to your client, right? So now, I know that you do rehab loans, right? So you have different ones, 203Ks and FHAs, 203Ks, or 203Ks, FHAs. rehab
Renovation,
loan, right?
yeah.
Yeah, and then you got a Fannie Mae for
Fannie
that.
Mae, home style.
The reason I bring that up is how many of you have a buyer that wants a pool? I hear it all day.
Yeah.
Hey, my guy wants a
Hey,
3-2 with a pool. I said, well, here's a 3-2. No, it doesn't have a pool. Can we add a pool?
Yeah.
The answer is yes.
Yeah.
And can we finance it?
Kitchens, pools,
You
you're
name it.
probably more an expert on that than I just,
We're getting back
Yeah,
to where
we're getting back
creative
to
is gonna
those
be
stuff,
what
yeah.
wins, okay?
Yeah.
Creative is what wins. So you come in and the kitchen's crap. So explain that process, what would happen with, let's say, a 203.
So if you have a Fannie Mae,
no, I'll do it, but yeah, go ahead.
we have a Fannie Mae home style renovation program where you come in and the buyer wants to do, it's harder on pools sometimes because, as you know, pools, the expense of a pool right now doesn't always equate to the value. But typically a kitchen, if you have a 1970s kitchen, if you put 25,000 into that, it would probably, so it's all gonna depend on what the appraisal is. So they do an appraisal based on the home with the improvements. And so we can finance that in and do a renovation loan and after closing, the money is dispersed in draws to the contractor to renovate the home. So we even have a little flyer that's like, shows the kitchen before and the kitchen after, you know. So it all is gonna depend on how much that's gonna increase the value, because it has to increase the value.
The reason I brought that up is because back in 2006, 2004, it was very hard to find certain things, right? So the way, and I got a bunch of them done, and the way I did it is I had the contractor come in and do a drawing, a rendering, right? Now I have that sitting on the counter. When they walk in, hey, here's the cost of it. By the way, we can loan it in with, we can put it in the loan with movement. Here's what the payment would be, and it would be a flyer from them.
Yep.
And that's right in front of them. So as they're walking through, they see it. And not everybody can connect the dots, but at least it's another avenue, right? Or a lanai or anything that you want. Just remember, you're gonna have to think outside the box. So if I walk in a house and it has that shag
When people
carpet,
walk through, oh, I love the house, but I hate the kitchen. Oh, I love the house, but I hate this master bathroom. There's, you know, like,
I can get a lot of them done.
What's the limits on it though? It's gotta be a certain percentage of the value of the house that you can do.
there is a formula. It's, you can do, and don't quote me on this, but it's like, say, it's 50% of whatever the improved values are. So let's say you're going to improve the house by $100,000. That's just a round number. You can do a $50,000 loan.
And there's certain different documentation, like some that require a contractor, some that don't, certain that comes a full renovation loan to a limited renovation loan, so.
Depends on what kind.
But that's more us, no, I mean, you
Yeah.
could get into it, but I wouldn't,
Yeah.
I'd use
For our
Mike's.
purposes,
Same for
guys,
that,
you
yeah.
write the deal like normal and you give it to him.
Yeah,
Yeah,
and I'll
that's
handle
right.
that stuff.
But you
Yeah.
can't do those on conventional FHA and VA.
And like Mike said too, like when he's back in 04, like the flyers, like, so if you guys, like even, and I'll go back to like this flyer right here, I could have your, I believe I can in my thing, I could have your mug, name, phone number, all that stuff right here.
We can
So when you go to the
co-brand it with
listing,
your
yeah,
info.
co-branded with you, and then, sorry, whatever. And then, also like Hometown Heroes, like if you guys, and I just found this out, like I just got some flyers made, but you guys could have your co-brand flyer there. And let's say you guys know you're going to the dentist next week or something. You're like, I just did that to me. I went to the dentist. For some reason, I was talking to him and I had my marketing team create me a flyer, Hometown Heroes, and it's for dental hygienists now. And I put flyers in their office. So if one of you guys, fire department, police, I know you guys know some people. If you want to hit on one of those sphere of influences, let's make a co-brand flyer, go drop it off to any of those things and get it done, you know? And
A
then,
loan officer in Port St. Lucie just closed a hometown hero for a nurse. So she had the flyers made up and the nurse put it on the bulletin board of the hospital and all down there. So there's lots of opportunities with that.
yeah.
That's interesting.
And then, I mean, if so flyers, I mean, if you, my office is, you guys may know, I'm right back there by the break room. There's cards there, email, whatever. I told Mike too, and I said that in the last class I did, if you guys want to pick my brain and get to know me or whatnot, I'll buy you lunch. Just let me know. We'll go to lunch and, you know, we'll talk, whatever. You want to talk business or whatever. And then, you know, develop relationship and see what we can do. Cause I'm happy to grow anyone's business, you know. I'll buy one. I'm gonna make you split it with me, Tariq.
So I know we, oh, sorry, go ahead.
So what you just said about, picking brains or whatever.
Yeah.
I had a discussion with Michael earlier and, about the hometown hero stuff.
Uh-huh.
And I do want to sit down with you because everything you're saying now, I want to go ahead and put a presentation together and deal with your time or whatever
Yeah.
to explain what you're doing to us now to potential buyers in
100%.
the medical field and, VAs that I know.
Yeah, I'd love to. Just call me, whatever. We'll set up some. I'm flexible. I have an office, Sebastian, and here, so I'm both places. But if we set up a time, I'll be happy to help you out.
Remember, he's our partner.
Yeah, so I'm not just from outside. Like I literally have, as many of you know, an office here.
So he's
So I
here to
help you
build
out,
your
man.
business.
Yep.
And in turn, it'll build his.
Correct.
So we talked about a lot of these, we talked about the buy down, we talked about the hometown heroes, and pretty much FHA being conventional or generic loans, not generic, but, common loans. But we also have, outlets for bank statement loans, investor cash flow loans. There's all kinds of alt-A stuff. If people don't show the income on their tax returns, but they have the flow going through their bank accounts. We're doing, several realtors recently doing this investor cash flow loan, where realtors are buying investment properties. And maybe you don't show all your income on your tax returns, but with the investor cash flow loan, you don't have to show any tax returns. So they get qualified based on the rental of the investment property. So there's a lot of different nuances and I don't want to get into all that, but just know that we have just about a loan for everyone.
Yeah, we went over that before, right?
Yeah, we did a
So it's a 25% down and then 25% down.
25% down, you do an appraisal. Let's say the appraiser says, hey, I know you're gonna rent this for $2,500 and the payment's $2,000. You're done. You just need credit and to show the down payment. I don't even put that you have a job. So for you guys, me on tax returns, you make this, you show this. 99% of self-employed people are like that. They can do it. Where other than that, they couldn't qualify for a loaf of bread. You know what I mean? So it's
25%?
25.
And they have a 20% option too.
Now they cut it back
Yeah.
5% with this market. Derek, yeah, what's
Yeah, there was didn't they sort of pass a new way to do the credit checks now? They're not doing the vitals or a new system that they're using, something.
I heard some of that online, but
Well, the one thing they're talking about, I just read something yesterday that Fannie Mae is looking at a new thing, but that hasn't been implemented yet.
hasn't been implemented.
But what they did I think it was July, they took off medical collection reporting,
Right,
which is really helping a lot of people.
and they're taking into account the rental, good standing in
Yes,
rentals and all
yes.
that stuff too to help.
Yeah, you can do some like
So,
alternate
you get
credit,
those
but
buyers
the
that,
big thing
I don't
I thought
have
was-
credit, I don't
yeah.
have this, well, you may have more than you know.
so they're working on some more stuff too, but that's not totally out yet. But I think they're working on improving the whole, what I read, I just remember what I read yesterday. Right now, we use all three bureaus, and you do the middle one of all three bureaus. Now they're gonna go to two bureaus, which I don't know if it's gonna help that much, but it might help a little bit, maybe get rid of the one score. So that's what I read yesterday, that they're working on implementing, but we'll
Or they
see.
take it away?
I don't know.
Okay, I just want to recap this and make sure, because what happens usually, I'm just speaking it generally, is that we'll get out of here and then somebody didn't ask the question that they wanted that would have benefited the whole group instead of just them. And then I get asked 5 more times, okay? So I just want to make sure that everybody's aware. We've gone over the 25% down investor loan we just went over, right? So what's the minimum credit score on that?
6, is it?
I think it's 680 maybe?
I'll get back to you on
Double
that,
check
but
on
it's
that.
gotta be decent. I think
So
it's
there's
6.
25% down, no income verification loan for investors. The only thing that has to do, the only thing that's qualified is the cash flow from the property. So if you know it's gonna rent out for a considerable amount more than what the note is, it's a great program.
Or if not, we can get around that too. So if you have somebody basically that wants to buy property or investment with no income, this is a program and we can look at all to make sure
There's no other qualification?
nothing, bro. No.
Credit.
So-
Credit.
Oh, credit.
Just credit,
Credit, and you have to have the
And
down
25.
payment. That's
but the
it.
down payment, they have to source it too and all that.
Yes.
Well, yeah, not the mattress.
There's no income.
Hey, but for 1 month, bank statement, not 2, 1 month.
But what I'm saying is, who could blast that program out on Facebook right now? Probably pick up an investor because nobody knows about it. That's what you gotta start thinking in terms of picking people up. to get them in, let him qualify. We don't qualify.
That's,
We just get them interested, get them with the person. That's the biggest thing. Fill your funnel. Because the more people you put in that funnel, the more deals you're gonna get. It's gonna get tough, guys. I'm just being honest with you. Okay, so you gotta start opening that brain up and start using stuff. So that's one. We went over arms, right? You have all the different arms available now. So 3, 5, 7, 10.
yes.
All those stand for years, by the way. So that's a fixed rate for the year arm. That means after that, 7-1 or 7 on, the interest rate will go back to the market rate, correct?
Yeah, it could go up, it could go down, depending upon after
That's what
that.
it's
So
initial.
Yeah.
it's fixed for whatever that number is in front of the arm. That's what that means.
Correct.
Very simple, okay? Then we have the 2-1 buy down that he's talked about there. That's good for sellers, put on there. I mean, who would know somebody's looking at the interest rate right now? Hey, I don't want to pay that 7.5%. Well, let me give you an option. Hey, I can give you an option to pay 2% less on your mortgage interest. Who's interested? Just put a general statement out there. You get everybody to put their hand up, start getting on the phone with them, and get them in contact with them. You're probably gonna pick somebody up. That's what I'm saying. Then you did regular buy downs, which is 1% equals whatever the loan amount is. So if it's a $500,000 house, 1% equals $5,000. Everybody get that? Okay, so that buys it down a quarter point-ish.
Rule of thumb, yep.
And then upfront underwritten, that's a 7-day,
2-3 days.
2-3 days.
Yeah. Difference between, like him was saying, pre-qual and pre-approval, that's the difference.
So every buyer I have, I'd be putting in that program, because now all I gotta do is get an appraisal that makes sense. The title has to work, and we close it, right?
Yep.
And you're done. So, I mean, imagine, as the sellers start getting more antsy, we can start making deals, especially when we can close quick. Right? That's what it's gonna get to. It's gonna get to, hey, you know what, you're overpriced by 50,000, we can close it in 7 days, we're already approved, and we're done. Sign here, press R, give me 3 copies. Or press the enter button on DocuSign 5 times. Okay, you get the gist. And then the 2 different reno loans that you got. And the reno loans are very important in this market. I'm telling you, you're gonna have people that can't find the house that they want, but we can probably create it if we get creative. Right, that's just what I'm taking from this. And I tried to put it in terms that you can understand on how we're just trying to get people to him. Don't do the, oh, that doesn't work for you. That's not our job. Our job is to say, hey, this may work for you, let's find out. And just follow up. And if it doesn't work out, put them in the follow-up program in your database. All right, because it might not work today, but it might work a year from now. Now you're stacking the deck. That's how 5 years from now you won't have to prospect.
And that's what he had done for one of my clients, remember?
Oh, yeah.
She came in, she didn't have 2 nickels to rub together, and he went ahead and he educated her to where she wound up buying, $250,000 house, but,
Awesome.
yeah.
And I don't mind
And that
doing
was
that,
up
like,
to
I mean,
what
I get,
practices
it's tough when you guys get a client, let's say, and a lot of the time it's first time home buyer where, hey, they may not know their credit, and I know you guys really can't ask or don't want to ask, or you don't know how much they make or their finances. I don't mind. Try to pre-screen them a little bit, and I'll let Mike tell you like what you can and can't do. I mean, I don't want you guys just say, oh, call Rick if you have, ask him a couple questions, but I've had plenty of clients that came with me at 500 credit, and guess what? That's going to be a client maybe 6 months, 6 years. I'm not going nowhere, so I don't mind helping them out. And usually if you do take the time, they're going to A, appreciate it. B, they're going to be a tremendous referral resource. And it's just, it's nuts. And it's cool when you get that 30 seconds at closing that they want to hug. You're like, man, thanks for working with me. That's what kills it for me. You know what I mean? That's like awesome. I feel that's a good feeling. You know what I mean?
Yeah, so we used to call that path to home ownership. So if you're going to get people on the path, they probably can't buy now, but if I put a thing on Eventbrite and I had him come on and say and go over the general rules of mortgage, most people don't know that they can buy for less than 20%. That's the stat. Most people think they have to have 20%. As soon as they find out they can do 3.5%, they're like, whoa, now you got a buyer, right? So now it'd be his job to say, okay, hey, you're not ready right now. Here's what we got to do to get you there 6 months from now, or a year from now, or 2 years from now. We can put you on a plan, maybe with a credit counselor, or however we got to do it. But that's where the follow-up. Fortune is in that follow-up. You're not doing this stuff. You've got to start thinking about it. This is where the rubber meets the road, and the skilled is going to win. For real. You've seen it.
Yep.
And it wasn't, but half the realtors fell out last time. And it's because they weren't doing this stuff. They waited too long to learn it. And then the market changed again and they had to learn a whole new market and they just said, no, I'm down, I'm out.
And that goes for me too. I can't tell you how many loan officers don't want to dig into different type of products or whatnot. And they just dwindle their paycheck. You know what I mean? It can only last so long.
Do you have any other programs you want to go over? Or we're not now,
I
right?
think that's pretty it. Do you have anything you want to think of?
That's
Any other
good.
questions that you
Do
guys
you have
think
any
of? Or
questions?
and
Any more
again,
questions?
if there's none, if you guys want to,
What was your name?
Sharon.
Sharon.
if you want to touch base with me off the record or individual, whatnot, again, my office is there and my card's there. You can, I gotta be careful on this. I guess you can text me. Yeah, text me, call me, email me, whatever.
And he's
I am
very
gonna try to be
responsive.
more here, as much as I can. But again, I mean, if you need something, if you want to meet a client together, I know a couple of you, we met, whether you're dumping a client off to me and just introducing, because sometimes you don't want to be in there and hear their finances just for whatever. And I get it. I don't mind that. Or some of them want you to be in there, just for the relationship. But I'm here to help grow business.
Did you guys find value in this stuff? Okay. All right.
It's a good program. And like I said, movement's good and I'm full of resources, whether it's Sharon, my team or whatnot, and Mike. He knows a ton too. I don't have to tell you guys that. So pick our brains and let's rock and roll.
I know we're gonna close this out, and I just want to say this is the shift book. Many of you know it. So how many of you know we just went over a shift tactic? Shift tactic number 10: creative finance. Number 10. There's 12 in here. All you gotta do is read it. It's the playbook. Well, this one's the
Yeah,
instructor
I don't
edition.
have that.
It's $40 if you want it. It's tabbed out, so you don't have to
Yeah,
thumb
I
through it.
like that.
But the important thing here is, if you remember from the office meeting, we went over find the motivated. That was shift tactic number 3. So I'm sprinkling this stuff in, and you don't even know it, but all of it is in this book. Okay. So hope you enjoyed it. We'll get through it.
Yes.
Thanks guys for
Thank
coming.
you.
There's some food there if you haven't eaten.